Hello and welcome to MF Corner. I'm Sonal Bhutra. With me is Vinnii Motiwala. And we have been talking about the mutual fund data that just came by. We saw that sharp fall in sectoral and thematic fund inflows. NFOs are lower as well. So it's a good time to discuss what's happening here.
Absolutely a good time to discuss all of this because especially sector and thematic funds, that is something, when you look at it, they picked up a lot of pace. They were in flavor last year, but that seems to have lost steam. And this is because of the strong cycle changes that happen as well. But, what should you be watching out for right now? What should your strategies be? Are they relevant? How are they moving as well? That is what we're going to be talking about today with Salonee Sanghvi, founder at My Wealth Guide, as well as Nasser Salim, who is the managing director at Flexi Capital, joining in with us. What's interesting is that over the last year, when you're just looking at it in terms of data, June 2024, NFOs and sectors accounted to around 22,000 crores in terms of what they had garnered. While in June 2025, today that data point is at just 475 crores. That's a big shift that has come in there. Now, Nasser, let me start with you. What are the main reasons behind this dramatic decline that we're seeing coming in from investors in terms of interest for sectors or thematic funds over this past year specifically? And is this a cyclical correction, or does this reflect maybe a bit more in terms of a structural shift from these sector bets?
Hello, Vinnii and Sonal. Great to be back on your show together. Thank you again for asking the most relevant question. Okay, so, over the past 8 to 10 months, Vinnii and Sonal, what began as a market correction is basically triggered by stretched valuations as of September 2024, which turned into a broader risk aversion. Investors started pulling out of high beta funds, which captures niche themes, a move towards more stable categories like, large cap funds or flexi cap funds as a category. I think a lot of this, was reactionary, in our opinion. Many had entered thematic and sectoral funds chasing past returns without fully understanding what may involve in them in terms of volatility. I think as markets turned, we saw sharp profit booking, SIP stoppages, and nearly a 98% drop in inflows. I mean, that's actually a big number. I think in our view, this isn't a structural shift, at least not for informed investors, I would say, Vinnii and Sonal. For those with balanced portfolios who understand risks, sector and thematic funds remain valuable as tactical satellite allocations. And that is broadly the way we see it. So we do not see it as a structural shift. It is obviously it's more valuable for as a tactical satellite allocation.
We take that point, Nasser. Salonee, thanks for joining into the conversation. Just adding on to what Nasser just also added, first, your thoughts on what is happening with this entire sectoral themes. And does this also suggest to you that sectoral funds, we cannot look at it from a long-term perspective? Absolutely. And one should book profits whenever they think that at the top of their cycle.
Thank you so much for having me on the show, Sonal and Vinnii. It's great to be here. So I concur with what he said that, flows into thematic funds are cyclical. They rise during bull markets, when themes are performing strongly, and fall during bearish phases. So, of course, one reason was the correction that we saw, and it was a broad-based correction. In fact, in certain sectors and themes, there were themes which had, almost delivered 100% return. And people landed up investing at that time. So there was a correction that was due. I think another reason was also NFO fatigue, and lack of new themes to invest in. Almost 79,000 crores were raised just in the last 1 year in thematic and sectoral funds. So I think that it is more of a cyclical correction versus a larger structural shift. Of course, FOMO does tend to drive a lot of investing.
Absolutely, and that's a big problem. FOMO shouldn't be driving your investing. So, Nasser, now what should investors do? How should they consider their allocation in sector and thematic funds? What if you're holding it since the last year? Then what should you do if a sector is not doing well? And how should they look to invest right now in this current market scenario? If they are new entrants, then should they look at sector and thematic funds?
So, Vinnii, two thoughts there. Number one, as we speak, the levels that we are currently at with all tactical calls, especially sectoral and niche themes, are now pretty much in the red in terms of price to earning bands, right? So we need to be a little cautious. I think some of these themes have been played out very favorably, while of course there is still juice left, but we need to be a little cautious before I get into that discussion. So I just want to kind of put that in place to our viewers and investors. I think these are high conviction strategies, Vinnii, designed to capture, either cyclical momentum or long-term mega trends, right? And because their performance is tied closely to macroeconomic shifts or policy tailwinds, I think, they always will remain to be volatile. So as I said, themes like consumption today, we've seen a rate cut that is played out by the RBI. The last was, of course, a 50 basis rate cut, as against most people were expecting only a 25 basis rate cut. That will have its impact on consumption. Those earning guidances of companies which are directly involved in the consumption space for investors, consumers, will start to play out over the next 3 to 6 months. EMIs will have lesser burden. People will like to aspirationally go for more purchases. There's also a budgetary tactical allocation that was done by the government of India, where they give a relief of almost up to 1 lakh crore. That all has to play out. So consumption as a theme, we still feel favorably, but again, it's not a loud out shout, Vinnii. I must tell you, your investors, it's a clearly a buy and dip strategy. Slow and steady tranches can go in there. The other one, of course, is manufacturing. I think the government of India has come and addressed. They've always been the ones who've actually picked up a lot of capex. A lot of heavy lifting has happened by the government of India. They continue to do so. I think private capex is yet to come in, but manufacturing is something which may be considered again to be bought in dips. There are certain themes there which are involved in infrastructure, the entire infrastructure ecosystem, which support manufacturing and allied sectors to that. I think the other one is green energy. But these are not short-term fads. There are structural stories, Vinnii, and what investors need to understand is that they have to have the right risk appetite and discipline to ride out these cycles, and we feel that they can still hold on to these as part of their long-term strategy. I see a lot of investors, we meet a lot of investors, and we see that it's a lot of FOMO. I agree with my fellow panelists there to say that IT did really well. Why don't we jump in? Today we're seeing a lot of good inflows coming in silver as an asset class, for example. But people need to understand, investors need to understand that it is also about portfolio positioning ultimately. Sectoral funds are best as satellite allocations, and maybe a 10 to a 20% of a portfolio tailored to an investor's conviction, risk profile, and horizon need to be looked in. So clearly, in the sectoral spaces, we like consumption. I think we do feel there's some opportunity in manufacturing, the green energy space, and while banks and financial services have played out reasonably well, there is some juice left in certain NBFCs. So therefore, cherry picking in that sector with certain fund managers and certain funds may position it really well in the portfolio.
Get that point, Nasser. Salonee, in that case, what's your take? Do you think the story that was playing out for sectoral funds in the last couple of months, it's over for now, or do you think we'll see an upcycle going forward? And once somebody's looking at implementing them, investing their money into sectoral funds, what are some of the things that they should keep in their minds?
So, as you rightly said, inflows have substantially tapered this year. But an important point is that the total AUM is still at an all-time high of 5 lakh crores, as of June. So that is still 15% of equity AUM. So while it is more a cyclical cool down versus a complete shift. So concentrated bets are, of course, higher risk and more tactical in nature. But the interest in themes and thematic funds is still high. So, I feel this is just a breather. There will always be new emerging sectors, themes, that would catch the fancy of investors. But it's important to keep a few points in mind before you really look at investing in sectoral or thematic funds. So sectoral funds are, of course, highly concentrated and cyclical. Only look at investing in a sectoral or thematic fund if you have high conviction in the theme. Don't invest solely basis, historically there have been good returns and that's why you're adding it to your portfolio. It's also important to see if that fund or theme fits your asset allocation and risk profile. So it fixes gaps in your existing holdings. Most diversified equity funds already have large weightages to, financial, tech, pharma, etc. So adding a sectoral fund in those segments will, of course, only increase concentration to that. Also, I think it's important to have the ability to monitor and rebalance. Tracking the sector closely and timing of entry and exit is crucial because you need to catch the cycle at the right time. Ideally, holding period should be at least 5 to 7 years, depending on the stage in the cycle. And this is despite underperformance. What tends to happen is there is some underperformance, and then people immediately exit the fund or that sector. I think again, I concur that 10% is a maximum that you should look at a sectoral or thematic fund in your portfolio, and this would be part of your satellite portfolio. I think another thing that is important to note and track is the liquidity metrics. When a sector underperforms, there will be large redemptions. So the fund has to be able to absorb those redemptions, and the stocks or the underlying investments, there should be enough liquidity for that. So I think when someone is looking at investing in sectoral or thematic funds, these are some of the important points that must be kept in mind.
Okay, important points there that one should keep in mind as well. So that is what we'll watch out for. Thanks for that. But on that note, we're going to slip into a very short break, viewers. After the break, we'll come back and discuss NFOs, what's happening there, what's trending there, how should we watch out for that after the short break.
Welcome back to MF Corner. Let's now focus on the new fund offerings. They have often attracted investor attention with the promise of fresh themes, innovative strategies, or entry at a low net asset value. We'll now try to understand how NFOs work, what they offer, how to decide if new fund fits your investment goals, and more. So basically, this time around, we did see that the flows coming in from NFOs have declined substantially in the month of June. 20 NFOs that garnered around 1,986 crore rupees, which compares with around 4,000 crore rupees that we saw in the month of May. So this is the decline that we've seen. So what's happening here? Let's get that conversation going. Lady, let me start with you first. What explains these dramatic swings in funds mobilized through NFOs? You think the investor appetite for new funds wane? Are there other underlying causes? Or the sectoral theme is not working and hence the NFOs are not working?
So, interestingly, if you look at the data for 2024, there were 231 NFOs last year. They mopped up almost 1,17,000 crores, that was the mobilization. This has been the all-time high record, which was largely, of course, driven by the bull market, and launch of multiple different themes. Now, what has happened is multiple niche categories already have many funds in that category, resulting in saturation. Your traditional categories already have 30, 40, 50 funds which are there in that category. Now, the thematic segments, also the niches, have multiple funds in that category. So I think there's also been some amount of NFO fatigue because now it is about what is new in the new fund coming up. Of course, market volatility due to geopolitical events also substantially reduced demand. I think appetite for NFOs has become more selective. For example, we saw Jio BlackRock raise almost 18,000 crores in their maiden NFO recently. So I think these are some of the reasons why the demand for NFOs has waned, in the last few months. One more point on the debt NFOs, I think, which was a popular segment because of the removal of the indexation benefit. Now there's no tax arbitrage, so the propensity to invest in a debt NFO also has reduced.
Absolutely interesting points there, and reasons why maybe we could see this fatigue that has actually come in for NFOs. Nasser, anything that you would like to add over there? And do you think, maybe now NFOs going forward also would struggle to attract large ticket sizes if there is no different niche that they come up with, given that there are already so many launches that we've seen?
No, actually, there has been a noticeable shift, Vinnii, in the NFO landscape, no doubt. I think fund houses are focusing, broadly on launching smaller thematic or passive funds now, which is gaining a lot of popularity, often tailored to specific sectors or strategies. But I think, several recent NFOs, including those by new entrants like Jio BlackRock, saw over 67,000 retail investors participate, showing growing interest at the grassroots level. The NFOs today are chasing large AUMs upfront, and it's more about offering customization. They're not chasing large AUMs, it's more about offering customized, differentiated and propositions to retail investors. I think that is the key. And that space is evolving with more selectively from AMCs and more thoughtful demand from investors. I think that's one essential point. in essence, the shift isn't a sign of weakness. I mean, in terms of lower number of NFOs, but a reflection of the industry maturing also, Vinnii, somewhere. And we see more quality targeted products, even if that means smaller ticket sizes and narrower reach initially. So I think, even SEBI's regulation allows only one fund now per category, which also makes it harder to launch large-scale general-purpose NFOs without overlapping existing products. So I think that is what is changing broadly and has changed, at least from the NFO landscape in the last few quarters.
That explains, because we saw that mad rush last year, the year before that. So it's just some fatigue, as you both have been pointing out, being seen in the NFO space as well. Salonee, in case somebody is looking at investing in an NFO, it's a first-time theme or a first-time fund as well, what should they consider before doing that versus, say, an established fund in the same category?
Right. So I think first would be what is the role of that NFO in their existing portfolio? Is it fulfilling a specific gap that no other existing fund can, and where it fits into the overall asset allocation? I think the second is the cost structure. Most people think, oh, the NAV is only 10 rupees, so it's so cheap. But people don't realize that the actual cost is the total expense ratio. Basically, a fund charges a fee which is a % of the portfolio, and that gets deducted from the returns. A fund with a smaller AUM can charge a higher expense ratio, whereas a fund with a larger AUM charges a lower expense ratio. There are also various marketing costs, initial NFO costs, even higher distributor commissions, which result in high expense ratios. So, the idea is to look at not just that 10 rupee NAV, but also look at the cost structure of the NFO. I think the other thing is a track record. A track record basically helps understand the kind of risk that the fund is taking, how well it does across various market cycles, in a bull market, in a bear market, etc. Relying just on the AMC or the fund manager's performance in other funds is not sufficient by itself. We only know the broad strategy and the mandate of the fund, but you don't know the portfolio constituents or whether it would be true to label. In an existing fund, you know exactly what you're getting into, you know what the portfolio is and whether it's a right addition to your portfolio. You can analyze the fund's actual holdings, sector allocation, how that has changed over time. So it gives you a much clearer picture of what you're investing in. I feel if there's already an active fund with a track record, then that is always a much better option versus an NFO. An NFO should only be considered if there is something new that sets it apart in terms of theme or strategy, which no other existing fund in the market is, following.
Okay. That's interesting there. And Nasser, would you like to add anything to that what a retail investor should watch out for? And also, if you could throw some light in terms of, upcoming NFOs that are looking exciting, anything that you are watching out for, and that actually becomes a good opportunity for an investor right now.
Right, Vinnii. So I think, broadly everything has been covered there. But I think one thing which I may want to add to that is timing really matters here also. I think several, NFOs tend to launch when themes are, there or sometimes near market peaks. I think investors should avoid getting swayed by narratives and instead ask whether the theme is backed by structural tailwinds and that aligns with their risk appetite and profile. I think that is something which is more important. I think the quick thing is, of course, which clearly mentioned is that, NFOs are actually built from scratch, Vinnii and Sonal, and there's uncertainty in portfolio construction. So I think it's already been covered, but one last point there is that, the pedigree of the fund house and fund manager is very, very critical there. And what we need to ask as investors, as subscribers to these NFOs is, has that team managed similar mandates successfully in the past or not? I think those are two very critical points. I think as far as the other point that you said is that, any recent ones that catch or may have caught our attention or will catch attention, I think, some of the themes which have captured on these passive and factor-based investing, those are which look a little interesting, which are expected to come out by a few other large AMCs. But obviously, there is, again, as I said to you, there have been a lot of successes and failures that offer lessons to investors, right? So that is something which we need to be very, very cautious of. I think factor-based investing is one of the few NFOs that are expected to come out by a few other AMCs. There are also, SIFs which are coming in place now by a separate regulation by SEBI under the mutual fund platform. So I think some of those as a separate category. So I think some of those are looking interesting and promising.
Okay, we take that point. A lot of interesting themes that you are watching out for. Salonee, have there been any recent NFO successes or failures that offer lessons for investors, something that looks interesting, something that, gives some sort of examples of what to do or what not to do, so to say?
I think what we've seen in the last few months, especially, is that if it's a simple product from a credible sponsor, we still see inflows. For example, BlackRock raised 18,000 crores in just 3 days. Also, I feel a well-constructed idea can deliver without even having a large mobilization. This is especially in case of passives or where they're tracking an underlying index. And again, as Nasser said, a hot theme, if you enter a hot theme late, there is a much higher chance of drawdowns. I think we've seen that in a lot of funds in the defense space that were launched on the back of great performance and then subsequently fell a lot more than other funds. I think one other thing, is that I feel like we will see the trend of smaller NFOs continue. This is because, there is a higher focus on niche ideas. And secondly, also as per SEBI rules from 1st of April, AMCs need to deploy these funds within 30 days. So it is much harder to deploy larger funds, especially in narrower themes. So if you raised a fund with 3,000 crores, it would be much harder to deploy that in 30 days versus a 200 to 500 crore kind of fund. So I feel like we will see a lot more very, very niche NFOs coming, going forward.
Salonee and Nasser, always a pleasure speaking with the two of you. Thank you so much for joining in today and telling us how to go about, say, sectoral themes and NFOs as well. Definitely very helpful for our viewers today.
Absolutely. But we'll wind down this edition. Thank you so much, viewers, tuning in as well. It's a goodbye from Sonal, myself, as well as the team who put the show together.